So, in my last video, I did a recap of what happened in the housing and mortgage world in 2025. The real things that happened, the things we were told that were going to happen, the things that didn't happen, the fake news, the real news, etc. So, that gave you a recap of what we actually saw versus what we were promised. But no one cares, right? They all just want to know what's going to happen in 2026. So, let's talk about some of the at least predictions. One of the predictions for 2026 is continued increases in home inventory. So if you're a buyer, this is a good thing. You have more properties to look at, hopefully different type of properties. You may have new construction properties that have good incentives on them, but you should still have a good amount of inventory to choose from depending on your area. So this also means we could potentially be staying in a buyer's market where you have more leverage when asking for a lower purchase price or for seller credits or items to be repaired. So that's a good thing. If you're a seller, you just have to know that there may be more properties just like yours on the market. So you have to work with your realtor and trust your realtor about appropriate pricing for your property or how to set your property apart. Now, to the only thing anyone cares about, interest rates. If I had probably even a penny for every time someone has asked me what's going to happen with interest rates, I wouldn't have student loans. And I'm here to tell you, fam, I got six figures in them. So I wish I knew. The only thing I can tell you with 100% certainty about interest rates, no one knows. Predicting interest rates is like predicting the weather. You only really know what's going to happen with the weather after the weather has happened, right? We have all this data to look at and try to predict the weather, but things happen. If you live in the South like us, hurricanes, for example. So we try to predict interest rates, but we have to look at past data, past promises, past political events, and what has happened to try to get an idea of where we are going. And like I said in my last video, the last couple of years, we have been promised many, many rate cuts that unfortunately did not really come to fruition. Rates have come down again substantially from where they were, but not necessarily to that break point of the low fives that a lot of people are looking for currently. So let's talk about what we think might happen as of right now for 2026. So as of right now, based on data and predictions, and that's predictions from Fannie Mae, Freddie Mac, Zillow.com, who no one cares what they think is going to happen. Everyone in between, rates are, as of right now, expected to not have a dramatic change next year. They are to stay around the 6 to 6.5% range. That's the prediction. And you're going, but wait, that's what they already are. Yes, that's exactly what they're saying, is that we shouldn't see a dramatic change in rates next year. And a lot of that is coming from the national inflation rates. The only way really we would see a dramatic change in interest rates, unless there's, again, like some hurricane like event, which honestly, after this last year, maybe. But in general, the only way we should see these dramatic changes in rates is if the economy worsens significantly. If unemployment continues to get significantly worse, if inflation continues to get significantly worse, we could see a change in housing interest rates, which would be amazing. But keep in mind, if you don't have a job, you don't have a mortgage anyway. If your mortgage is lower in interest rate and saves you $60 a month, but eggs now cost $60, you're not saving. So we don't just need a drop in interest rates, truth be told, because that's not always a good sign economically. What we need is changes to how we do loans, to interest rates as well, to the economy in general, to employment. We need a strengthening of multiple areas to make that reduction in interest rates just be the best thing you've ever seen. So you might be saying to yourself now, well, that's not very exciting. Like, that's pretty crappy. Why would you tell us that? It's actually not in the long run, because if you haven't tracked housing data for years and years and years, then what you aren't seeing is that each time we do see a reduction in interest rates, we see buyers reflooding the market. We go into a seller's market. Sellers know, hey, I hold the inventory you need. You suddenly want my house. Now I want top dollar for it, right? If you're bidding on something online, for example, and there's 100 people bidding on one item, they're not going to continue to drop the price. If anything, it's going to continue to go up. So each time rates go down, we see housing prices shoot up, right? Because now we're back in a seller's market and they know you want to buy their house. So you lose a lot of the leverage that you had with the lower interest rates with the housing prices going up. So just like the cost of something at the grocery store, while we would love for it to just drop and go down to nothing, it's not realistic to happen, or gas prices. However, if we could keep the price of something the same year after year and it not get any worse, that's actually better for us in the long run, affordability wise. What we need is we need housing prices to stay stable. We need housing prices to stay the same. We need incomes to continue to rise without heavy inflation on the back end making everything else more expensive. That's where we hit more of the sweet spot of affordability for people. And hopefully, we will see some reforms in the housing industry that are positive. I know there's been a lot of talk about 40-year mortgages, 50-year mortgages, assumable mortgages, transportable mortgages. We don't know what's going to come down the pipe, truth be told. It's a lot of dreams and wishes and thoughts, but we don't know what's actually going to happen. But we do know, as of right now, rates should stay about the same, which should keep housing prices about the same, which should keep us in a relative buyer's market, giving you a lot more leverage to ask for something from the seller to actually help your mortgage. Now, for my refi people, people who are in higher interest rates, you have a temporary buy down that's about to expire. You did a non-QM loan, like a DSCR loan or bank statement loan, and you've got that higher rate and you've been holding out. You're just waiting and waiting and waiting for those rates to drop. I'm here to tell you, this is probably your time to go ahead and look at refinancing. You may not see a significant drop in those interest rates through the year, and the amount of interest you're going to pay waiting is probably not going to be worth it. So this is probably the time to start looking at that refinance, see if we can go ahead and get you into a better interest rate, or if you're in a temporary rate buy down, can we go ahead and get you into a good rate to hold long term? So is it the most amazing news ever for 2026? No, but honestly, after the last couple of years, no news is good news. We just need the housing industry to calm down and stay stable while the rest of the world tries to get its you know what together. If you have any questions, though, you want to talk about your scenario, when to refi, when to buy, how to do it, reach out.